all takes us to our talk of the tape. How do you want to be positioned with stocks here at all-time highs? Joining me now is Goldman Sachs' Meena Flynn. Meena, it's great to have you on the show from the private wealth department. What are you telling your clients at this point now that we have seen such a strong melt up in stocks?
Absolutely. We're encouraging our clients to continue to stay invested and with incremental capital to really look to put that to work over a 6 to 18 month time period. And we are expecting drawdown. So whenever you've got a market that's at the 10th decile, such as what we are now, it is likely that you're going to get a drawdown. In fact, there's an 80% probability of a 10% drawdown. That being said, valuations aren't the best predictor of what forward market performance is going to be. So we've been in that 10th decile since December of 2016. And since that time, the market's actually returned 200%. So we're really focused on earnings.
What about the sentiment from your clients? I know you represent a lot of family offices and all different types of clients. What are you hearing?
Client sentiment, I would say, is relatively mixed. And so I would say that if you look at our wealth management clients, they are neutral to risk on. And so, as you mentioned, work with family office clients. We just did an insights report that looked at a cohort of these clients. And they're actually 30% of them are looking to decrease the amount of cash that they're going to hold over the next 12 months and go into public equities and private equities. And this is an investor cohort that's already 70% plus risk on. When I say it's mixed, I say that because if you look at the hedge fund levels, you look at mutual fund levels, despite markets being at all-time highs, this positioning is relatively light. Hedge funds, 40th percentile of net long. Mutual funds are sitting on $170 billion of cash.
So there's room.
So there's room. There's actually a good amount of right tail risk to the market as well as clearly left tail risk.
Yeah, a lot of people say also, the trillions of dollars sitting in money market funds too.
$7.3 trillion in money market funds. And as rates start coming in, you start to see that go out the risk curve as well as the more confidence you get that the Fed's going to get this right. And what we see the Fed doing and what we see the economy doing is kind of slowing a little bit into the end of the year and then really picking up in 2026. The economy. So the Fed said it a little bit yesterday in their SEP and the comments in terms of just this slowdown and then this reacceleration. And that's really driven by both fiscal and monetary stimulus as well as a weaker dollar.
So it raises the question, do you have confidence in what the Fed is doing? And do you have confidence on what they will be doing? Because some of those dots on their expectations for rates were all over the place.
It was definitely a scattergram, but I think the Fed gave the market what it wants in the sense that it's cutting, and they said that they're going to continue to cut into an economy that is growing.
Right, and you think that will be the sort of impetus, the force that brings the money off the sidelines?
I think there's a multitude of things. One is that. One is the fiscal stimulus that's going to lead to more cash in the hands of consumers as well as corporations. Another is if you're able to start seeing the attachment points from the AI CapEx to the revenue generation. This market is very AI heavy, and so anything from that vantage point is going to bode well as well.
Right. I mean, so much has been priced in, though, when it comes to the AI spending. And I know that every quarter we have seen those numbers on CapEx go higher. Question is, how long can that go?
You're right. CapEx and AI, if you look at it, it's doubled in terms of spending over the last 2 years. We've gone from $150 billion to $300 billion of spending. But if you look at these companies spending relative to the cash flow, it used to be when you look at the tech bubble, you look at you look around that time period, it was 100% of their cash flows. It's 50% of their cash flows now. Also, when you look
in other words, no bubble.
Don't think we're in a bubble because look at valuations also.
Yeah.
Valuations are at 28 times for the largest 5 stocks. If you look at 2021, that was 43 times, and it was 50 times during the tech bubble.
And you're saying there's more cash even to play with here?
And there's more cash to play with. And also, these companies, they have a tremendous ROE. Again, the top 5 stocks, an ROE of 65%. They grew over 20% in the first half. So I don't think you want to be betting against this trend going into the end of this year or into 2026.
So you're very bullish, clearly.
I wouldn't say I'm very bullish. I actually think we're going to hover around these levels into the end of the year because there's a lot that's coming up on the economic data front, labor, inflation. I do think inflation is going to tick up before it ticks down, and so the tariff impact is going to continue to hit us. But you've got some of the other trends in inflation, such as wage growth, such as rent growth, actually coming down. And so that's why you see inflation kind of doing this. And again, very noteworthy of where valuations are as well. And this, this market is not necessarily driven by the economy. It's more driven by earnings. And so that's really what we have to keep our pulse on. And so, like I said, I think the market's probably going to stay around current levels into the end of the year. And then I think we trend moderately higher in 2026.
So I mentioned small caps look set to have their time at a record high. Finally.
Small caps are definitely on a run. I think they're up something like 8 of the last 9 weeks. And I think you just said closing at all-time highs. The one thing I would just be mindful of is that the concoction that we have right now is kind of a perfect setup for small caps in the sense of you've got a growing economy and you've got declining rates. But look at last year as an example. Last year, the Fed cut rates 100 basis points. And you also had GDP of 3%. So more than what we have right now. And last year, the S&P outperformed small cap on an absolute basis as well as on a Sharpe ratio basis.
So you're saying beware.
I'm saying that I prefer large and mid cap.
Yeah.